While you're reading this sentence, somewhere in America, a homeowner just discovered their property lost 8% of its value in the past 12 months. This isn't speculation or fear-mongering. It's the stark reality of an American real estate market undergoing its most dramatic transformation in over a decade. The numbers don't lie, and they're impossible to ignore. Recent data reveals that 1/3 of America's major housing markets are already experiencing price declines, shattering the myth that real estate only goes up. What seemed impossible just 3 years ago has become inevitable. The Great Correction has arrived, and it's reshaping the landscape faster than most anticipated. But here's what mainstream media won't tell you. This isn't just a story about falling prices. It's about a fundamental recalibration that's creating both devastating losses and extraordinary opportunities. While some homeowners watch their equity evaporate, savvy investors are positioning themselves for what could be the most significant wealth transfer in real estate history. The confluence of factors driving this transformation is unprecedented. Federal Reserve policies have pushed mortgage rates to levels not seen since 2008, effectively pricing out millions of potential buyers. Meanwhile, inventory levels are surging in previously supply-constrained markets, creating a perfect storm of reduced demand and increased supply. Add climate-related insurance costs, shifting work patterns, and regional economic disparities, and you have a recipe for dramatic market disruption. What makes this situation particularly critical is its speed and selectivity. Unlike the broad-based crash of 2008, today's market decline is surgically precise, targeting specific cities and regions with laser-like accuracy. Some markets are experiencing double-digit declines, while others remain relatively stable, creating a patchwork of risk and opportunity that demands sophisticated analysis. The cities we'll examine aren't random selections or clickbait targets. They're markets where multiple risk factors are converging with mathematical precision. These are places where decades of growth may reverse in months, where million-dollar homes could become $800,000 properties, and where the American dream of homeownership is being stress-tested like never before. For current homeowners, this information isn't meant to create panic but to provide actionable intelligence. Understanding which markets face the greatest pressure allows you to make informed decisions about your most valuable asset. For potential buyers, these insights reveal where patience might be rewarded with significant discounts. For investors, this analysis identifies both markets to avoid and opportunities to capitalize on others' misfortune. The data we'll present comes from the most reliable sources in real estate analytics: Redfin, Realtor.com, Federal Reserve Economic Research, and institutional investment reports. Every claim is verifiable, every projection is based on quantifiable trends, and every recommendation is grounded in decades of market analysis. This isn't about predicting the future with certainty. Real estate markets are too complex for such arrogance. Instead, it's about understanding probability, recognizing patterns, and positioning yourself advantageously regardless of which scenario unfolds. The question isn't whether change is coming to these markets. It's already here. The question is whether you'll be among those who benefit from understanding it first. The American housing market is experiencing its most significant transformation since the 2008 financial crisis, marked by a convergence of economic forces that have fundamentally altered the landscape. Nearly 1/3 of major U.S. housing markets now see falling home prices, representing a dramatic shift from the pandemic-era surge that saw values skyrocket across the nation. The primary catalyst driving this transition has been the Federal Reserve's aggressive interest rate policy, which has pushed 30-year fixed mortgage rates to stay between 6.5% and 7%. This represents more than a doubling from the sub-3% rates that fueled the pandemic buying frenzy. As of early July, bank rate data showed that the average rate for a 30-year fixed mortgage was just below 7%, creating an affordability crisis that has effectively sidelined millions of potential buyers. Simultaneously, housing inventory has begun to normalize after years of severe shortages. As of July 2025, home supply was increasing, but not to the point where the number of homes for sale had caught up to pre-pandemic numbers. This gradual rebalancing between supply and demand has created conditions ripe for price corrections in overheated markets. Regional disparities are becoming increasingly pronounced, with traditionally high-cost areas in the South and West experiencing the most dramatic adjustments. The phenomenon isn't uniform. While some markets face steep declines, others maintain stability or modest growth, creating a patchwork of conditions that requires careful analysis for anyone considering real estate transactions. The next 5 years will likely usher in more sales activity, but expect flatter price increases, suggesting that the era of double-digit annual appreciation may be permanently behind us. This new reality demands a recalibration of expectations and strategies for both buyers and sellers navigating the transformed landscape of American real estate. Cities in focus tone. Investigative and specific high-risk Category 1. Miami, Florida. Current situation. Miami's housing market, which exploded during the pandemic, is now seeing rising inventory and dipping sales. The city that became synonymous with luxury real estate speculation is experiencing what analysts describe as a dramatic market correction. Median home prices, which soared to unprecedented heights of over $600,000 for single-family homes, are now showing clear signs of decline. Condo prices are declining in 92% of Florida's housing markets, while single-family home prices are falling in 66% of Florida's housing markets. Miami's luxury condo market, particularly vulnerable due to speculative buying, has seen inventory levels triple compared to 2023 levels. The city's days on market metric has extended from an average of 25 days in 2022 to over 90 days in late 2024. Price reductions have become commonplace, with approximately 40% of listings showing price cuts within 60 days of initial listing. The foreign investor exodus, particularly from Latin American buyers, has created a significant demand vacuum that domestic buyers cannot fill at current price levels. Risk factors. Miami faces multiple converging pressures that make it particularly vulnerable. Climate change presents the most serious long-term threat, with rising sea levels and increasingly severe hurricane seasons driving insurance costs to unsustainable levels. Property insurance premiums have increased by 300–400% in some coastal areas, effectively pricing out middle-class buyers. The city's economy, heavily dependent on tourism and international investment, remains volatile and susceptible to global economic disruptions. The speculative nature of Miami's recent boom has created an artificial price floor that doesn't align with local income levels. With median household income around $44,000, homes priced above $500,000 require external funding sources that are rapidly diminishing. Construction costs remain elevated while demand wanes, creating a supply-demand imbalance that favors buyers over sellers. Projections: 12 to 24 months. Conservative estimates suggest Miami home prices could decline 10 to 15% over the next 18 months, with luxury segments potentially seeing 20 to 25% corrections. The condo market faces particular pressure due to new state regulations requiring reserve studies and special assessments, which could add $10,000 or $50,000 in unexpected costs for unit owners. Market stabilization is unlikely before late 2025, assuming no major hurricane events or economic disruptions. Rental markets may provide some support as failed sales convert to rental properties, but this increased rental supply will pressure rental yields. The luxury segment above $1 million faces the steepest corrections as international buyer interest remains subdued and domestic buyers lack purchasing power at these levels. Investor impact: current property owners face immediate equity erosion, particularly those who purchased in 2021–2022 at peak prices. Strategic investors with strong cash positions may find opportunities in distressed luxury properties, but should expect extended holding periods before market recovery. The rental market opportunity exists for investors who can weather 2 to 3 years of negative or flat appreciation while building rental income streams. Flip investors should avoid Miami entirely until clear market bottoms emerge. Buy and hold investors might consider entry points 15 to 20% below current asking prices, focusing on properties with minimal climate risk and strong rental demand fundamentals. International investors should wait for currency stability and clearer long-term insurance solutions before committing capital. 2. Austin, Texas current situation. Austin was one of the biggest winners during the pandemic home buying frenzy, but now experts say the floor has fallen out in the city's housing market. The Texas capital, which saw median home prices surge from $350,000 in 2019 to over $550,000 at peak, is experiencing a dramatic correction that few predicted would be this severe. Current market data shows home sales down 35% year over year, with inventory levels reaching 4.5 months supply compared to just 1.2 months in 2022. The city's tech-driven economy, which fueled rapid price appreciation, is now working against the market as major employers implement layoffs and hiring freezes. Companies like Meta, Amazon, and Tesla have reduced their Austin workforce expansion plans, directly impacting housing demand. Price reductions are evident in 55% of active listings, with average reductions of 8 to 12% from initial asking prices. Days on market have extended dramatically, from an average of 15 days in 2021 to over 75 days currently. The luxury segment above $800,000 faces particular challenges, with some properties sitting unsold for 120+ days despite price reductions. New construction continues to flood the market, adding pressure to existing home sales and creating oversupply conditions. Risk factors. Austin's rapid population growth during the pandemic created an artificial demand surge that masked underlying affordability issues. With median household income around $80,000, the current median home price of $480,000 requires income levels that exclude significant portions of the local workforce. The city's dependence on the volatile tech sector creates employment uncertainty that directly translates to housing market instability. Property taxes in Austin represent one of the highest burdens nationally, often exceeding 2.5% annually, which adds $12,000 in annual costs for median-priced homes. This tax burden becomes increasingly problematic as home values decline but tax assessments remain elevated. The rapid construction boom has created quality concerns with many new developments, potentially leading to future maintenance and value issues. Infrastructure strain from rapid growth has created traffic congestion, school overcrowding, and utility stress that diminish the city's attractiveness to new residents. Water supply concerns during Texas drought conditions add another layer of long-term risk for sustained population growth. Projections: 12 to 24 months. Market analysts project Austin home prices could decline 12 to 18% over the next 18 months, with luxury segments potentially seeing 25% corrections. The tech sector's health will largely determine recovery timing, with current trends suggesting sustained weakness through 2025. New construction completions scheduled for 2025 will continue pressuring prices as builders compete for a shrinking buyer pool. Rental markets may provide some stability as failed homeowners become renters, but increasing rental supply from converted investment properties will pressure rental yields. The sub-$400,000 market segment may find support from first-time buyers, while luxury markets face extended correction periods. Investor impact: recent purchasers face significant equity losses, particularly those who bought at 2021-2022 peak prices with minimal down payments. Cash investors may find opportunities in distressed new construction inventory, but should expect 3 to 5 year holding periods for appreciation recovery. Rental investment opportunities exist for investors focusing on properties near major employment centers and transportation corridors. Fix and flip investors should exercise extreme caution as renovation costs remain elevated while sale prices decline. Buy and hold strategies may work for investors who can secure properties 20-25% below current asking prices and weather extended negative appreciation periods while building rental income streams. 3. Phoenix, Arizona current situation. Phoenix represents one of the most dramatic market corrections currently underway in American real estate. Phoenix prices have decelerated and fallen below 2022 peak levels, marking a significant reversal from the city's pandemic-era boom. Median home prices, which peaked at over $520,000, have already declined to approximately $465,000, representing a 10% correction with further declines expected. The Valley of the Sun attracted massive population influx during remote work trends, driving unsustainable price appreciation that divorced housing costs from local economic fundamentals. Current market conditions show inventory levels at 3.8 months supply, the highest since 2011, while sales volumes have declined 28% year over year. Price reductions now appear on 45% of active listings, averaging 7 to 10% from original asking prices. New construction activity remains elevated from previous planning cycles, adding approximately 40,000 new units annually to a market experiencing reduced buyer demand. This supply-demand imbalance continues pressuring prices downward, particularly in outer suburban developments where speculative building was most aggressive. Days on market have extended from 20 days in 2022 to 85+ days currently. Risk factors: Phoenix faces unique structural challenges that amplify its housing market vulnerability. Water scarcity represents the most critical long-term risk, with Colorado River allocation cuts directly impacting the region's growth sustainability. Climate change intensifies these challenges through extreme heat, drought conditions, and infrastructure strain that reduce the area's long-term attractiveness. The local economy's dependence on construction, tourism, and retiree migration creates cyclical vulnerability during economic downturns. Population growth, which fueled the recent boom, has decelerated significantly as remote work policies reverse and cost advantages diminish. Rising utility costs from extreme climate conditions add operational expenses that reduce housing affordability. Property insurance costs are escalating due to extreme weather events, adding hundreds of dollars in monthly housing expenses. The speculative nature of recent investment activity, particularly from California cash buyers, created artificial demand that is rapidly reversing as those investors exit positions. Projections: 12 to 24 months. Housing analysts project Phoenix could experience 15 to 20% price declines over the next 18 months, with some suburban markets potentially seeing 25% corrections. The city's historically cyclical nature suggests this correction could be severe but relatively short-lived if economic conditions stabilize. However, water restrictions and climate concerns may limit recovery speed compared to previous cycles. New construction completions scheduled through 2025 will continue adding supply pressure, particularly in master-planned communities on the urban fringe. Rental markets face pressure from increasing supply as failed sales convert to rentals, though population growth may provide some demand support. Investor impact: Current homeowners purchased after 2020 face substantial equity losses, with many already underwater on recent purchases. Strategic investors with long-term horizons may find opportunities in quality established neighborhoods with water access certainty, but should plan for extended holding periods. Rental property investors might benefit from population growth continuing at reduced rates, creating steady tenant demand. However, extreme climate costs and water restrictions could impact long-term rental yields. Fix and flip investors should avoid Phoenix entirely until clear market bottoms emerge, while buy and hold investors should focus on established areas with proven water rights and climate resilience. 4. Las Vegas, Nevada current situation. Las Vegas housing market exemplifies the boom-bust cycles that have historically characterized Nevada real estate. The city experienced explosive pandemic-era growth, with median home prices surging from $315,000 in 2020 to over $480,000 at peak, an increase that far exceeded local income growth capacity. Current market conditions reveal significant stress, with home sales declining 32% year-over-year and inventory levels reaching levels not seen since 2012. Las Vegas prices have fallen below 2022 peak levels, currently averaging $445,000 for median single-family homes, representing an 8% decline from peak with accelerating downward momentum. The city's dependence on tourism and entertainment, combined with its attraction to California relocations, created artificial demand that is rapidly reversing as economic conditions shift. Price reductions now appear on 50% of active listings, with average cuts of 8 to 15% from initial asking prices. Days on market have extended from 25 days in 2021 to over 95 days currently, indicating fundamental demand weakness. New construction continues flooding the market from previous development cycles, adding supply pressure in a declining demand environment. Risk factors. Las Vegas faces multiple structural vulnerabilities that compound its housing market risks. The economy's dependence on discretionary spending through tourism and entertainment makes it extremely sensitive to national economic conditions and consumer confidence. Recent corporate event reductions and business travel declines directly impact local employment and housing demand. Water scarcity represents a critical long-term challenge, with Lake Mead at historic low levels and Colorado River allocation cuts threatening future growth sustainability. Climate change intensifies these challenges through extreme heat and drought conditions that may limit the region's long-term population growth potential. The city's history of boom-bust cycles creates psychological market factors where buyers and sellers remember previous dramatic corrections, leading to decreased confidence and increased volatility. Speculative investment activity from California buyers created artificial price floors that don't align with local income levels, averaging $58,000 median household income. Nevada's lack of state income tax, while attractive, cannot offset housing costs that require income levels significantly above local medians. Construction quality concerns from rapid building periods may create future maintenance and value issues for recent developments. Projections: 12 or 24 months. Market analysts project Las Vegas could experience 12 to 20% price declines over the next 18 months, with outer suburban markets potentially seeing larger corrections. The city's historical volatility suggests rapid corrections followed by potential recovery, but water restrictions may limit recovery speed compared to previous cycles. Tourism recovery rates will significantly influence housing market timing, with current trends suggesting continued weakness through early 2025. New construction completions will continue pressuring prices, particularly in master-planned communities where speculative building was most aggressive. Investor impact: recent purchasers face immediate equity challenges, particularly those who bought with minimal down payments at 2021-2022 prices. Cash investors may find opportunities in established neighborhoods with gaming industry employment proximity, but should expect extended recovery periods. Rental markets may benefit from failed homeowners converting to renters, though increasing rental supply from distressed properties will pressure yields. Short-term rental investors face particular challenges as tourism recovery remains uncertain and local regulations become more restrictive. Buy and hold investors should focus on properties near stable employment centers and avoid outer suburban developments with questionable long-term viability. Fix and flip strategies should be avoided until clear market bottoms emerge and tourism recovery demonstrates sustainability. Moderate high-risk category 5. Denver, Colorado current situation. Denver's housing market reflects the broader Mountain West correction pattern, experiencing significant cooling after years of rapid appreciation. Denver prices have decelerated and fallen below 2022 peak levels, with median home prices declining from approximately $580,000 at peak to current levels around $525,000, representing a 9% correction with continued downward pressure. The mile-high city attracted substantial population growth during remote work trends, driving price appreciation that exceeded local economic fundamentals. Current market indicators show sales volumes down 25% year-over-year, with inventory levels reaching 3.2 months supply compared to just 1.1 months in 2021. The luxury segment above $700,000 shows particular stress, with extended days on market and frequent price reductions. Colorado's appeal to California and coastal relocations created artificial demand during the pandemic that is now reversing as those buyers reassess cost-benefit calculations. Price reductions appear on 38% of active listings, averaging 6 to 9% from initial asking prices. New construction activity remains elevated from previous planning cycles, continuing to add supply pressure in a softening demand environment. Risk factors. Denver faces several converging challenges that amplify housing market vulnerability. The local economy's dependence on energy, aerospace, and federal employment creates cyclical sensitivity to national economic policies and energy market fluctuations. Recent layoffs in tech and aerospace sectors directly impact high-income buyer segments that drove recent price appreciation. Climate change presents increasing risks through wildfire threats, drought conditions, and extreme weather events that drive up insurance costs and reduce long-term attractiveness. Property insurance premiums have increased 40 to 60% in wildfire-prone areas, adding significant monthly costs for homeowners. Water scarcity concerns, while less immediate than southwestern markets, still represent long-term growth constraints as Colorado River allocations face cuts. The state's recreational appeal, while attractive, creates seasonal employment patterns that don't support year-round housing costs at current levels. Rising property taxes due to recent assessments based on peak values create additional affordability pressures as home values decline, but tax obligations remain elevated. Traffic congestion from rapid growth has diminished quality of life factors that previously justified premium housing costs. Projections: 12 to 24 months. Housing analysts project Denver could experience 8 to 15% additional price declines over the next 18 months, with mountain communities and luxury segments potentially seeing larger corrections. The market's stability will largely depend on energy sector performance and federal employment levels, both showing current weakness. Population growth rates have decelerated significantly as cost advantages diminish and remote work policies reverse. New construction completions scheduled through 2025 will continue adding supply pressure, particularly in suburban developments on the urban fringe. Investor impact: current homeowners face equity erosion, particularly those who purchased at peak prices with minimal down payments. The rental market may provide some stability as failed buyers become renters, though increasing rental supply from converted investment properties will pressure yields. Strategic investors with strong cash positions might find opportunities in established neighborhoods with employment center proximity, but should plan for extended recovery periods. Mountain resort properties face particular challenges as recreational spending patterns shift and climate risks increase. Buy and hold investors should focus on properties with stable employment proximity and avoid new construction inventory. Fix and flip strategies require extreme caution due to elevated construction costs and declining sale prices, creating compressed profit margins. 6. Seattle, Washington current situation. Seattle's housing market demonstrates the Pacific Northwest's adjustment to post-pandemic economic realities. Seattle prices have decelerated and fallen below 2022 peak levels, with median home prices declining from approximately $850,000 at peak to current levels around $725,000. Representing an 8% correction with continued pressure expected. The Emerald City's tech-driven economy created unsustainable price appreciation during the remote work boom, attracting buyers who could afford premium prices based on inflated tech compensation packages. Current market conditions show inventory levels at 2.8 months supply, the highest since 2019, while sales volumes have declined 22% year-over-year. Major tech employers including Amazon, Microsoft, and Meta have implemented significant layoffs and hiring freezes, directly impacting the high-income buyer segment that drove recent appreciation. Price reductions now appear on 35% of active listings, with luxury properties above $1 million showing average cuts of 10 to 15% from initial asking prices. Risk factors. Seattle faces unique challenges that compound housing market vulnerability. The technology sector's current volatility creates employment uncertainty for the precise demographic that drove recent housing demand. Stock option compensation, which enabled many tech workers to purchase expensive homes, has lost significant value as tech stocks decline. Regulatory environment creates additional pressures through rent control discussions, development restrictions, and tax policy changes that may reduce investor interest. The city's progressive taxation approach and business climate concerns are driving some employers to consider relocations, potentially impacting long-term employment base. Climate change, while less immediate than other markets, presents risks through increased wildfire smoke, flooding, and earthquake concerns that may affect long-term desirability. Construction costs remain among the nation's highest due to labor shortages and regulatory requirements, limiting new supply but also making renovation and maintenance expensive. Projections: 12 to 24 months. Market analysts project Seattle could experience 10 to 18% additional price declines over the next 18 months, with luxury tech corridor properties potentially seeing 20-25% corrections. Recovery timing depends heavily on tech sector stabilization and return-to-office policy implementations by major employers. The rental market may provide some support as high-income tech workers who cannot buy become renters, though increasing supply from failed sales will pressure yields. International buyer interest, particularly from Asia, remains subdued due to geopolitical tensions and currency considerations. Investor impact. Recent purchasers, particularly those who bought luxury properties with stock-based down payments, face significant equity challenges. The rental market opportunity exists for investors who can weather extended holding periods while building income streams from tech worker tenants. Established neighborhoods with employment center proximity may offer opportunities for patient investors, but should expect 3 and 5-year recovery periods. Luxury investments above $1 million face particular challenges as tech compensation packages normalize and buyer pool shrinks. International investors should wait for clearer tech sector recovery signals and political stability before committing capital. Fix and flip strategies face compressed margins due to high construction costs and declining sale prices, requiring extreme selectivity in project selection. 7. Portland, Oregon current situation. Portland's housing market exemplifies the Pacific Northwest's broader adjustment challenges, experiencing significant correction after years of rapid appreciation. Portland prices have decelerated and fallen below 2022 peak levels, with median home prices declining from approximately $575,000 at peak to current levels around $525,000, representing a 9% correction with continued downward momentum expected. The Rose City attracted substantial in-migration during remote work trends, driving price appreciation that exceeded local economic capacity. Oregon's lack of sales tax and perceived quality of life advantages drew California and Washington buyers who could afford premium prices, creating artificial demand that is now reversing as those buyers reassess cost-benefit calculations. Current market indicators show inventory levels at 3.5 months supply, the highest since 2011, while sales volumes have declined 30% year-over-year. Days on market have extended from 25 days in 2021 to over 80 days currently, indicating fundamental demand weakness across all price segments. Risk factors. Portland faces multiple structural challenges that amplify housing market vulnerability. The local economy's dependence on manufacturing, technology, and small business creates sensitivity to national economic conditions and supply chain disruptions. Recent corporate relocations and business climate concerns reduce long-term employment stability. Social and political factors create additional uncertainty, with ongoing urban policy debates, public safety concerns, and quality of life issues affecting buyer perceptions. Homeless encampment policies and downtown revitalization challenges impact overall city attractiveness to potential residents. Climate change presents increasing risks through wildfire threats, air quality concerns, and extreme weather events that drive up insurance costs and reduce desirability. The state's aggressive environmental regulations, while well-intentioned, create construction cost increases that limit housing supply elasticity. Property taxes based on recent peak assessments create affordability pressures as home values decline, but tax obligations remain elevated. Oregon's unique property tax system and measure limitations create budget uncertainties that may impact municipal services and infrastructure investment. Projections: 12 to 24 months. Housing analysts project Portland could experience 12 to 20% additional price declines over the next 18 months, with suburban markets and luxury segments potentially seeing larger corrections. The city's recovery will depend significantly on business climate improvements and urban policy stability. Population growth has decelerated as cost advantages diminish and urban quality of life concerns increase. New construction activity has slowed due to regulatory challenges and cost increases, potentially providing some supply relief but limiting economic recovery. Investor impact: current homeowners face equity erosion, particularly those who purchased during 2020-2022 peak periods with minimal down payments. The rental market may provide some stability, though increasing supply from failed sales will pressure rental yields. Strategic investors might find opportunities in established neighborhoods with employment proximity, but should plan for extended recovery periods and carefully evaluate urban policy risks. Properties in suburban markets may offer better stability than urban core investments given current social challenges. Buy and hold strategies require careful location selection, focusing on areas with stable employment and minimal urban policy impact. Fix and flip investments face regulatory challenges and compressed margins that require expert local knowledge and significant capital reserves. 8. Dallas, Texas. Current situation. Dallas represents the broader Texas market adjustment, experiencing cooling after years of explosive growth driven by corporate relocations and population influx. Dallas prices have decelerated and fallen below 2022 peak levels, with median home prices declining from approximately $425,000 at peak to current levels around $395,000, representing a 7% correction with continued pressure expected. The Metroplex attracted massive corporate relocations during the pandemic, including major companies like Charles Schwab, CBRE, and numerous tech firms, driving employment-based housing demand. However, current market conditions show inventory levels at 3.1 months supply, while sales volumes have declined 20% year-over-year as buyer demand softens across all price segments. New construction activity remains elevated from previous planning cycles, adding approximately 60,000 new units annually to the market. This supply increase coincides with reduced buyer demand, creating downward price pressure particularly in outer suburban developments where speculative building was most aggressive. Risk factors. Dallas faces several challenges that amplify housing market vulnerability despite its generally strong economic fundamentals. The rapid population growth that fueled recent appreciation has created infrastructure strain, traffic congestion, and utility capacity concerns that may limit future growth attractiveness. Property taxes in Texas represent significant ongoing costs, often exceeding 2.2% annually, which adds $8,700 in annual expenses for median-priced homes. These tax burdens become more problematic as home values decline, but assessments remain based on higher previous valuations. Climate change presents increasing risks through extreme weather events, including severe storms, flooding, and extreme heat that drive up insurance and utility costs. The state's power grid vulnerabilities, demonstrated during recent weather events, create infrastructure reliability concerns for long-term residents and businesses. Economic diversity, while generally strong, includes significant exposure to energy sector volatility that can impact employment and population growth during industry downturns. The rapid construction boom has created quality concerns with some new developments, potentially leading to future maintenance and value issues. Projections: 12 to 24 months. Market analysts project Dallas could experience 8 to 12% additional price declines over the next 18 months, with outer suburban markets potentially seeing larger corrections as commuting patterns normalize post-pandemic. The market's recovery will depend on continued corporate relocation trends and employment growth sustainability. New construction completions scheduled through 2025 will continue adding supply pressure, particularly in master-planned communities on the urban fringe. However, Dallas's economic diversity and growth fundamentals suggest a potentially faster recovery compared to more cyclical markets. Investor impact. Recent purchasers face moderate equity challenges, particularly those who bought new construction at peak prices with minimal down payments. The rental market opportunity exists due to continued population growth, though increasing rental supply from failed sales will pressure yields. Strategic investors might find opportunities in established neighborhoods with employment center proximity, particularly areas benefiting from corporate relocations. Buy and hold strategies may work for investors who can secure properties at appropriate discounts and weather 2 to 3 year holding periods. Fix and flip investors should exercise caution due to elevated construction costs and declining sale prices, focusing on properties requiring minimal renovation in established neighborhoods. International investors may find opportunities in commercial and residential properties serving relocating corporations. Emerging risk category 9. Tampa, Florida current situation. Tampa Bay represents Florida's emerging market correction pattern, with conditions deteriorating rapidly after years of pandemic-driven appreciation. Nick Gurley, the CEO of Reventure App, expects prices to drop by up to 10% in Florida cities such as Tampa and Sarasota. Median home prices, which surged from $285,000 in 2020 to over $425,000 at peak, are beginning to show decline signals with current levels around $405,000. The Tampa metropolitan area experienced massive population influx during remote work trends, attracting buyers from higher-cost northeastern markets who could afford premium prices. Current market indicators show concerning trends with inventory levels increasing to 2.9 months supply, while sales volumes have declined 18% year-over-year across all price segments. Price reductions are becoming more frequent, appearing on 32% of active listings with average cuts of 5 to 8% from initial asking prices. Days on market have extended from 22 days in 2021 to over 65 days currently, indicating emerging demand weakness particularly in luxury segments above $500,000. Risk factors. Tampa faces mounting challenges that suggest significant housing market vulnerability ahead. Climate change represents the most critical long-term risk, with hurricane frequency and intensity increasing alongside rising sea levels that threaten coastal property values. Property insurance costs have increased 200–300% in many areas, adding $300–800 monthly to housing expenses. The local economy's dependence on tourism, healthcare, and retiree services creates vulnerability during economic downturns and demographic shifts. Population growth, while historically strong, shows signs of deceleration as cost advantages diminish and climate risks increase awareness. Construction costs remain elevated while demand softens, creating supply-demand imbalances that favor buyers over sellers. The speculative investment activity from northeastern buyers created artificial price floors that don't align with local income levels averaging $52,000 median household income. Traffic congestion from rapid growth has created infrastructure strain that diminishes quality of life factors previously justifying premium housing costs. Water management and flood control systems face increasing stress from development density and climate change impacts. Projections: 12–24 months. Housing analysts project Tampa could experience 8–15% price declines over the next 18 months, with coastal areas and luxury segments potentially seeing larger corrections. The market's direction will largely depend on hurricane season severity and insurance market stability. Rental markets may provide some support as population growth continues at reduced rates, though increasing supply from failed sales will pressure rental yields. The tourism-dependent economy's recovery patterns will significantly influence employment stability and housing demand sustainability. Investor impact: current homeowners purchased since 2020 face emerging equity challenges, particularly those in high insurance risk areas. Strategic investors with climate risk expertise might find opportunities in inland properties with flood protection, but should plan for extended recovery periods. Rental property investors may benefit from continued population growth creating tenant demand, though climate insurance costs will impact rental yields. Short-term rental investors face particular challenges as insurance costs increase and climate risks affect tourism patterns. Buy and hold investors should focus on properties with minimal climate risk and strong employment proximity, while avoiding coastal luxury segments. Fix and flip strategies require careful risk assessment due to insurance cost impacts on buyer financing and market absorption rates. 10. Boise, Idaho current situation. Boise represents the Mountain West's pandemic boom adjustment, experiencing rapid deceleration after explosive appreciation that attracted national attention. Median home prices surged from $320,000 in 2020 to over $525,000 at peak, an increase that far exceeded local economic capacity and created affordability crisis conditions for existing residents. Current market conditions show clear cooling trends with inventory levels reaching 7-month supply, the highest since 2019, while sales volumes have declined 28% year-over-year. The California relocation trend that drove recent appreciation is reversing as buyers reassess cost-benefit calculations and remote work policies normalize. Price reductions now appear on 30% of active listings, with average cuts of 6–10% from initial asking prices. Days on market have extended from 15 days in 2021 to over 70 days currently, indicating fundamental shift in buyer-seller dynamics across all price segments. Risk factors. Boise faces several emerging challenges that suggest significant housing market vulnerability. The local economy's limited diversity creates sensitivity to national economic conditions and remote work policy changes. Major employers remain concentrated in government, healthcare, and manufacturing sectors that cannot support current housing price levels for most workers. Population growth, while historically strong, was artificially accelerated by pandemic-era relocations that may not prove permanent. As remote work policies reverse and travel costs increase, some California transplants are reconsidering their relocation decisions. Water supply concerns represent a growing long-term risk as Idaho faces drought conditions and Colorado River system stress. Climate change impacts through wildfire threats, extreme weather, and agricultural water competition may limit future growth sustainability. Construction costs remain elevated due to material shortages and labor constraints, while demand softens, creating margin pressures for builders and developers. New construction activity continues from previous planning cycles, adding supply pressure in a cooling market. Projections: 12–24 months. Housing analysts project Boise could experience 10–18% price declines over the next 18 months, with luxury segments above $600,000 potentially seeing 20–25% corrections. The market's stability depends heavily on employment diversification and retention of pandemic-era transplants. Rental markets may provide some support as failed buyers become renters, though increasing supply from investment property conversions will pressure yields. The tourism and recreation economy provides seasonal support but creates employment volatility. Investor impact: recent purchasers face immediate equity challenges, particularly California buyers who paid premium prices for perceived value compared to their home markets. The rental market opportunity exists for investors focusing on properties near stable employment centers. Strategic investors might find opportunities in established neighborhoods with employment proximity, but should expect extended recovery periods as market fundamentals realign. Mountain and recreational properties face particular challenges as discretionary spending patterns shift. Buy and hold strategies may work for investors who can secure significant discounts from current asking prices and weather 3 or 5-year recovery periods. Fix and flip investments should be avoided due to elevated construction costs and declining sale price environment creating compressed margins. 11. Nashville, Tennessee current situation. Nashville exemplifies the Southeast's pandemic boom adjustment, experiencing cooling conditions after years of explosive growth driven by entertainment industry expansion and corporate relocations. Median home prices surged from $275,000 in 2020 to over $450,000 at peak, creating affordability challenges that are now impacting market demand sustainability. Music City attracted substantial population growth during remote work trends, drawing buyers from higher-cost markets who could afford premium prices. Current market indicators show emerging stress with inventory levels increasing to 2.5 months supply, while sales volumes have declined 15% year-over-year across all price segments. Price reductions are becoming more common, appearing on 28% of active listings with average cuts of 5 to 7% from initial anatomy of risk factors. Understanding the multifaceted nature of housing market risks requires examining both macroeconomic forces and localized vulnerabilities that can trigger price corrections. The current market downturn isn't driven by a single factor, but rather a complex interplay of economic, environmental, and demographic pressures that vary significantly across different metropolitan areas. Climate change and natural disasters represent an increasingly critical risk factor that fundamentally alters property values and insurance costs. Coastal areas face rising sea levels and hurricane intensification, while western regions grapple with wildfire risks that have made entire neighborhoods uninsurable. These environmental pressures create long-term structural challenges that traditional market analysis often underestimates, forcing property values to reflect the true cost of climate risk. Economic diversification deficits pose significant threats to markets overly dependent on single industries. Cities built around tech hubs, energy sectors, or manufacturing face heightened vulnerability when their primary economic driver experiences downturns. The work-from-home revolution has particularly impacted markets that benefited from corporate concentration, as distributed work models reduce the premium for proximity to business centers. Affordability imbalances have reached critical thresholds in numerous markets, where median home prices exceed what local median incomes can realistically support. These imbalances create unsustainable conditions that inevitably require correction through either price reductions, income growth, or population exodus. Markets with the greatest price-to-income ratios often experience the most severe corrections. Infrastructure and regulatory pressures compound market vulnerabilities through aging utility systems, inadequate transportation networks, and restrictive building codes that limit supply responses. Additionally, tax policy changes at state and local levels can rapidly alter market attractiveness, as seen in high-tax states experiencing outmigration to more favorable jurisdictions. Demographic shifts, including aging populations, changing household formation patterns, and interstate migration trends, create demand fluctuations that can destabilize previously stable markets. Understanding these underlying population dynamics provides crucial insight into which markets face sustainable demand versus those experiencing temporary bubbles. Smart strategies for current homeowners. The priority should be proactive market monitoring rather than panic-driven decisions. Establish trigger points for potential action by tracking local inventory levels, days on market, and price per square foot trends. Consider strategic improvements that enhance marketability while avoiding overinvestment in volatile markets. Refinancing opportunities may emerge if rates decline, but focus on building equity through principal payments rather than relying solely on appreciation. Homeowners in high-risk markets should evaluate their financial flexibility and consider whether current market conditions present optimal exit opportunities. However, remember that real estate remains a long-term investment, and temporary market corrections don't necessarily justify abandoning sound properties in fundamentally strong locations. For prospective buyers, this environment offers unique opportunities for those with strong financial positioning and patience. If your finances are in order and it's the right stage of your life, it could be a smart time to buy a house. Focus on markets with strong economic fundamentals rather than chasing the lowest prices, as distressed markets often reflect underlying structural problems. Target properties priced below replacement cost and negotiate aggressively, as sellers increasingly face carrying costs and opportunity pressures. Secure pre-approval at current rates but remain flexible on timing, as market conditions continue evolving rapidly. Consider adjustable rate mortgages if planning shorter-term ownership, as future rate decreases could provide significant savings. For real estate investors, this transition period demands sophisticated analysis and risk management. Diversifying your investments can help spread risk across different markets and property types. Focus on cash-flowing properties rather than appreciation plays, as rental demand often remains stable even during price corrections. Consider distressed opportunities in fundamentally sound markets, but avoid falling knives in areas facing structural economic challenges. Tech tools make decision-making easier, while green investments attract more buyers, suggesting that technology-enabled analysis and environmentally conscious properties may outperform traditional approaches. Maintain adequate liquidity reserves and avoid excessive leverage, as market volatility creates both opportunities and unexpected challenges that require financial flexibility to navigate successfully. Future perspectives and scenarios. The trajectory of the American housing market through 2025-2026 will likely be determined by the intersection of monetary policy, demographic trends, and economic resilience. For the most part, industry experts do not expect the housing market to crash in 2025, but significant regional variations and adjustment periods appear inevitable. Baseline scenario, 60% probability. Markets experience gradual price normalization with 5 to 15% corrections in overheated areas, while stable regions see modest appreciation of 2 to 4% annually. A modest drop in mortgage rates could prove to be a magic bullet for the U.S. housing market, potentially stabilizing conditions if rates decline to the 5.5–6.5% range by late 2025. Optimistic scenario, 25% probability. Economic resilience and employment strength support housing demand, while supply constraints prevent significant price declines. Technological innovations in construction and financing create new market efficiencies, and international investment flows provide additional market support. Interest rate stabilization around 6% enables increased transaction volumes without triggering oversupply. Stress scenario, 15% probability. Economic recession coincides with continued high interest rates, creating sustained pressure on housing markets. Forced sales from over-leveraged investors and distressed homeowners accelerate price declines in vulnerable markets. Credit availability tightens significantly, extending the adjustment period and creating opportunities primarily for cash buyers. Critical factors that will determine which scenario unfolds include Federal Reserve policy responses to economic data, employment market stability, and geopolitical impacts on financial markets. Mortgage rates, land, labor, inventory levels, and the political atmosphere will each have major influence on the trajectory of the housing market in 2025. The most successful market participants will be those who remain adaptable to changing conditions rather than betting exclusively on any single outcome. This environment rewards careful analysis, patient capital, and the ability to act decisively when opportunities align with fundamental value propositions. Regional diversification and attention to local economic drivers will prove more valuable than broad market timing strategies in navigating this complex transition period. Powerful conclusion. The American real estate market isn't breaking. It's recalibrating. This fundamental distinction separates those who will thrive in the next phase from those who will merely survive. While headlines scream about crashes and collapses, the reality is far more nuanced and, for the prepared investor, far more profitable. What we've witnessed in these 11 cities represents more than isolated market corrections. It's a preview of how modern real estate markets respond to converging pressures. Unlike the broad-brush devastation of 2008, today's adjustments are surgical, targeting specific vulnerabilities with precision that would have been impossible in previous decades. This selectivity creates unprecedented opportunities for those who understand the underlying mechanics. The data tells a clear story. Markets that seemed invulnerable just months ago are now experiencing double-digit declines. Properties that commanded premium prices are sitting unsold for 60, 90, even 120 days. Sellers who refused reasonable offers in 2023 are now accepting bids they would have rejected as insulting just 12 months earlier. This isn't speculation, it's happening right now, in real time, in markets across America. For current homeowners in these cities, the message isn't panic but preparedness. Your home's value may be declining, but your strategy doesn't have to be reactive. Understanding these trends allows you to make proactive decisions, whether that means accelerating a sale, refinancing while equity remains, or simply adjusting expectations for the next few years. Knowledge eliminates the paralysis that comes from uncertainty. Potential buyers face a different but equally compelling opportunity. The same forces driving down prices are creating buying opportunities that haven't existed since the aftermath of the Great Recession. Patient buyers with solid financing are discovering that seller desperation translates directly into negotiating power. The key lies in distinguishing between markets experiencing temporary corrections and those facing structural declines. Investors, meanwhile, are witnessing the emergence of a two-tier market system. While some areas experience distress, others maintain stability or even growth. This disparity creates arbitrage opportunities for those sophisticated enough to recognize them. The winners will be those who can identify undervalued assets in temporarily distressed but fundamentally sound markets. The next 18 months will separate the strategic from the reactive. Economic headwinds, changing demographics, and evolving work patterns will continue pressuring vulnerable markets. But these same forces are creating value in markets that adapt quickly. The question isn't whether opportunities will exist. They already do. The question is whether you're positioned to recognize and capture them. Smart money isn't fleeing real estate. It's becoming more selective. The broad-based buying of the past decade is giving way to targeted acquisitions based on rigorous analysis. This new environment rewards research, patience, and strategic thinking while punishing speculation and emotional decision-making. The market has spoken, and its message is clear. The era of universal real estate appreciation is over. In its place comes a more complex but potentially more rewarding landscape, where success belongs to those who understand that in every correction lies the seeds of the next expansion. The question isn't whether you'll participate in this transformation. It's whether you'll be among those who profit from understanding it first.